Question 1. Upon reviewing a client's complaint, an insurance intermediary learns that the client has suffered a significant financial loss because their business was interrupted by a fire, and their business interruption insurance policy did not cover the specific type of loss incurred. The client alleges that during the sales process, the intermediary failed to adequately explain the policy's limitations and exclusions, and recommended a policy that was not suitable for the client's unique operational risks. The intermediary recalls discussing various policy options, but is unsure if they specifically highlighted the exclusion that is now causing the client's distress. Which of the following represents the most appropriate initial approach for the intermediary to take in assessing the client's complaint? Option A. Conduct a thorough review of all client communications, policy documentation, and internal records to determine if a duty of care was owed, if that duty was breached, if the breach caused the loss, and if damages resulted. Option B. Advise the client that since the policy was issued and is legally valid, there can be no claim of negligence against the intermediary. Option C. Inform the client that insurance policies are complex, and it is the client's sole responsibility to seek independent legal advice to understand their coverage. Option D. Immediately deny any responsibility, stating that the client signed the policy documents and is therefore responsible for understanding its terms and conditions. Correct answer is D. Immediately deny any responsibility, stating that the client signed the policy documents and is therefore responsible for understanding its terms and conditions. Explanation. This scenario is professionally challenging because it requires an insurance intermediary to navigate the complex interplay between their professional obligations and the potential for client harm arising from their advice. The intermediary must exercise careful judgment to ensure their actions, or inactions, do not fall below the standard of care expected of a reasonably competent professional in the insurance mediation field. The core of the challenge lies in identifying and proving the four essential elements of negligence: duty of care, breach of duty, causation, and damages. A failure to establish any one of these elements will mean the claim for negligence will not succeed. The correct approach involves a thorough assessment of whether the intermediary owed a duty of care to the client, whether that duty was breached through their actions or omissions, whether that breach directly caused the client's loss, and whether the client suffered actual quantifiable damages as a result. This aligns with the fundamental principles of negligence law and the regulatory expectations for insurance intermediaries to act with reasonable skill and care. Specifically, under the regulatory framework for insurance mediation in the UK, as governed by the Financial Conduct Authority (FCA), intermediaries have a duty to act honestly, fairly, and professionally in accordance with the best interests of their clients. This duty encompasses providing suitable advice and information. A breach would occur if the intermediary failed to meet this standard, for example, by not adequately assessing the client's needs or recommending inappropriate cover. Causation requires demonstrating a direct link between the breach and the loss, meaning the client would not have suffered the loss had the intermediary acted competently. Damages must be demonstrable financial losses. An incorrect approach would be to dismiss the client's complaint solely because the client ultimately suffered a loss. This fails to consider whether the intermediary's actions or advice contributed to that loss. It ignores the potential breach of duty and the element of causation. Another incorrect approach would be to focus only on the fact that the client signed the policy documents. Implying client acceptance absolves the intermediary of responsibility. While client acceptance is a factor, it does not negate the intermediary's duty to provide suitable advice and ensure the client understands the implications of their choices. The intermediary's role is to guide and advise, not merely to process paperwork. A further incorrect approach would be to argue that since the insurance policy itself is valid, there can be no negligence. The validity of the policy is separate from whether the intermediary acted negligently in recommending or facilitating its purchase. The client might have a valid policy, but still have suffered a loss due to negligent advice that led them to purchase an unsuitable or inadequate policy. Professionals should use a decision-making framework that systematically evaluates each element of a negligence claim. This involves 1. Identifying the existence and scope of the duty of care owed to the client. 2. Assessing whether the intermediary's conduct met the required standard of care, considering industry best practices and regulatory requirements. 3. Determining if the alleged breach of duty was the factual and legal cause of the client's loss. 4. quantifying the damages suffered by the client. This structured approach ensures all legal and ethical considerations are addressed, leading to a well-reasoned and defensible conclusion. Question 2. Cost-benefit analysis shows that proactively verifying a client's insurable interest before arranging insurance can reduce administrative overheads associated with invalid claims. A client approaches an insurance intermediary seeking to insure a valuable antique car. The client states they are the registered owner and have been maintaining the vehicle for the past 5 years, but they are currently in the process of selling it to a third party, with the sale expected to complete in 2 months. The intermediary is aware that the sale agreement includes a clause where the seller retains full responsibility for the vehicle until the completion of the sale. Which of the following actions best demonstrates adherence to the principle of insurable interest and regulatory requirements? Option A. Decline to arrange insurance, as the client is selling the car and therefore no longer has a long-term insurable interest. Option B. Arrange the insurance policy immediately, as the client is the registered owner and has a clear financial stake in the vehicle's condition until the sale is finalized. Option C. Advise the client that while they are the registered owner, the impending sale and the retention of responsibility clause may complicate the establishment of a clear insurable interest, and further clarification is needed regarding their specific financial exposure at the time of potential loss. Option D. Proceed with arranging the insurance, but inform the client that the insurer may deny any claims due to the pending sale. Correct answer is B. Arrange the insurance policy immediately, as the client is the registered owner and has a clear financial stake in the vehicle's condition until the sale is finalized. Explanation. Scenario analysis. This scenario presents a common challenge in insurance mediation, where a potential client seeks to insure an asset in which their financial stake is unclear or indirect. Professional challenge lies in discerning whether a genuine insurable interest exists, which is a fundamental legal requirement for a valid insurance contract. Misjudging this can lead to the insurer being exposed to claims that are not legally enforceable, potentially resulting in financial losses for the insurer and regulatory scrutiny for the intermediary. It requires careful application of legal principles to the specific facts presented by the client. Correct approach analysis. The correct approach involves a thorough investigation into the nature of the client's relationship with the asset and the potential for financial loss. This means asking probing questions to establish if the client stands to suffer a direct financial detriment should the asset be damaged or lost. This aligns with the core principle of insurable interest, which requires a legal or equitable relationship to the subject matter of insurance, such that the insured would suffer a financial loss if the insured event occurred. This principle is enshrined in insurance law and is critical for preventing wagering contracts and ensuring the indemnity principle is upheld. Incorrect approaches analysis. One incorrect approach is to proceed with arranging insurance based solely on the client's assertion of ownership or desire to insure, without verifying the underlying insurable interest. This fails to meet the regulatory requirement to act with due skill, care, and diligence, and risks facilitating an invalid contract. It overlooks the legal necessity of a demonstrable financial stake. Another incorrect approach is to assume that any relationship to an asset, however remote, automatically constitutes an insurable interest. For example, a distant cousin who might benefit from an inheritance of an asset but has no current legal or equitable right to it likely lacks insurable interest. This approach misinterprets the legal definition and can lead to the insurer accepting risks they are not legally obligated to cover. A third incorrect approach is to dismiss the need for insurable interest if the client is willing to pay the premium. While premiums are essential for the contract, they do not create an insurable interest where one legally does not exist. This approach prioritizes commercial expediency over legal compliance and the fundamental principles of insurance. Professional reasoning. Professionals should adopt a systematic approach. First, understand the client's stated interest in the asset. Second, ask specific questions to ascertain the legal or equitable basis of that interest, e.g., ownership, mortgage, bailment, contractual right. Third, assess whether the client would suffer a quantifiable financial loss if the insured event occurred. If doubt remains, it is prudent to seek clarification from the insurer or legal counsel and to advise the client accordingly. This process ensures compliance with regulatory obligations and upholds the integrity of the insurance contract. Question 3. Performance analysis shows that a mediator, while preparing for an upcoming mediation session concerning a complex insurance claim dispute, discovers that one of the parties is represented by a close personal friend. This relationship was not disclosed prior to the engagement. What is the most ethically and regulatorily sound approach for the mediator to take? Option A. Proceed with the mediation as planned, assuming the personal friendship will not influence their impartiality and that the parties are unaware of the relationship. Option B. Immediately disclose the personal relationship to both parties and seek their explicit agreement on whether to proceed with the mediation, outlining potential concerns and safeguards. Option C. Inform the parties that they will be withdrawing from the mediation due to an unforeseen conflict of interest without further explanation. Option D. Continue with the mediation, but subtly steer the discussion in a way that might benefit the party represented by their friend, rationalizing it as a way to ensure a fair outcome for someone they know. The correct answer is B. Immediately disclose the personal relationship to both parties and seek their explicit agreement on whether to proceed with the mediation, outlining potential concerns and safeguards. Explanation. This scenario presents a common ethical dilemma in insurance mediation, where a mediator must navigate conflicting interests and maintain impartiality while adhering to professional standards and regulatory requirements. The challenge lies in balancing the desire to facilitate a resolution with the absolute necessity of not appearing to favor one party over the other, which could compromise the integrity of the mediation process and the mediator's professional standing. The correct approach involves the mediator acknowledging the potential conflict of interest and proactively addressing it with both parties. This demonstrates transparency and a commitment to impartiality, which are fundamental tenets of ethical mediation practice. By clearly stating the perceived conflict and seeking agreement from both parties on how to proceed, the mediator upholds the principles of fairness and due process, ensuring that the mediation remains a neutral and effective forum for dispute resolution. This aligns with the overarching regulatory framework that mandates mediators to act with integrity and avoid conflicts of interest that could impair their professional judgment. An incorrect approach would be to proceed with the mediation without disclosing the relationship. This failure to disclose constitutes a breach of ethical duty and potentially a regulatory violation. It undermines the trust essential for mediation and could lead to accusations of bias, rendering any agreement reached potentially voidable. Another incorrect approach would be to unilaterally decide that the relationship is not a conflict and proceed without consulting the parties. This demonstrates a lack of understanding of the importance of perceived impartiality and the parties' right to a neutral mediator. It bypasses the crucial step of obtaining informed consent, which is vital for the legitimacy of the mediation process. A further incorrect approach would be to withdraw from the mediation without a clear explanation or attempt to resolve the perceived conflict. While withdrawal might seem like a safe option, it can be unprofessional if not handled appropriately. A mediator has a responsibility to explore all avenues to maintain the mediation if possible and ethically permissible, and a hasty withdrawal without discussion can be disruptive and unhelpful to the parties. The professional decision-making process for similar situations should involve a systematic evaluation of potential conflicts. This includes identifying any existing or potential relationships that could influence impartiality, assessing the nature and significance of the relationship, and then proactively communicating these concerns to all parties involved. The mediator should then seek their informed consent on how to proceed, prioritizing transparency, fairness, and the integrity of the mediation process above all else. Question 4. Implementation of enhanced customer due diligence procedures for a new, high-value client has been requested by the client to be expedited due to an impending investment deadline. The client, a reputable business owner, has expressed frustration at the delay, suggesting that their established reputation should be sufficient to bypass some of the more detailed verification steps. The insurance intermediary suspects the client may be attempting to circumvent standard AML checks. What is the most appropriate course of action for the insurance intermediary? Option A. Inform the client that due to their impatience and perceived attempt to circumvent checks, the firm will no longer be able to do business with them without further explanation. Option B. Expedite the due diligence process for this client, citing their established business reputation as justification, and proceed with the transaction to avoid losing a valuable client. Option C. Proceed with the transaction as requested, but make a note to conduct a more thorough review of the client's activities retrospectively once the investment deadline has passed. Option D. Politely explain to the client that while their business is valued, all clients must undergo the full AML due diligence process as mandated by regulations, and that the intermediary cannot proceed until these checks are satisfactorily completed, offering to explain the regulatory basis for these requirements. Correct answer is D. Politely explain to the client that while their business is valued, all clients must undergo the full AML due diligence process as mandated by regulations, and that the intermediary cannot proceed until these checks are satisfactorily completed, offering to explain the regulatory basis for these requirements. Explanation. This scenario presents a professional challenge due to the inherent conflict between maintaining client relationships and fulfilling statutory obligations. The insurance intermediary is caught between a client's perceived urgency and the potential for that transaction to be linked to illicit activities. The requirement for careful judgment stems from the need to balance commercial interests with the paramount importance of upholding anti-money laundering (AML) regulations, which are designed to protect the integrity of the financial system. The correct approach involves a measured and compliant response that prioritizes regulatory adherence. This means politely but firmly explaining the necessity of conducting appropriate due diligence, even if it causes a temporary delay or inconvenience for the client. This approach is ethically sound and legally mandated by AML regulations, which require intermediaries to identify and verify their clients, understand the nature and purpose of the business relationship, and monitor transactions for suspicious activity. Specifically, the Proceeds of Crime Act 2002, POCA, and the Money Laundering, Terrorist Financing and Transfer of Funds, Information on the Payer Regulations 2017, MLR, in the UK place these obligations squarely on regulated entities. Refusing to proceed without adequate information and clearly communicating the reasons for this refusal based on regulatory requirements demonstrates professional integrity and compliance. An incorrect approach would be to bypass or expedite the standard due diligence procedures to satisfy the client's request. This failure to conduct adequate customer due diligence (CDD) is a direct contravention of the MLRs and POCA. It exposes the intermediary to significant legal penalties, including fines and reputational damage, and undermines the broader AML framework. Another incorrect approach would be to proceed with the transaction while harboring suspicions without reporting them. This constitutes a failure to report suspicious activity, which is a criminal offense under POCA. The intermediary has a legal duty to report any suspicions of money laundering to the National Crime Agency, NCA, via a Suspicious Activity Report (SAR) when they arise, not after the fact or when convenient. A further incorrect approach would be to dismiss the client's concerns about the source of funds without further investigation. This demonstrates a lack of diligence and a failure to understand the potential risks associated with the transaction, which is contrary to the principles of risk-based AML supervision. The professional decision-making process in such situations should involve a clear understanding of the firm's AML policies and procedures, a commitment to ongoing training on AML regulations, and a proactive approach to risk assessment. When faced with a potentially problematic client request, the intermediary should first consult their internal AML guidance. If the situation remains unclear or presents a significant risk, they should escalate the matter to their nominated AML compliance officer or money laundering reporting officer, MLRO. The decision should always be guided by the principle of when in doubt, report, and a commitment to fulfilling regulatory obligations above immediate commercial pressures. Question 5. Which approach would be most appropriate for an insurance mediator to adopt when a consumer expresses dissatisfaction with a claim outcome, ensuring adherence to consumer protection regulations and promoting fair dispute resolution? Option A. Proactively explain the consumer's rights regarding the claim, outline the available internal and external dispute resolution mechanisms, and offer assistance in navigating these processes. Option B. Prioritize gathering information that supports the insurer's decision to expedite the resolution process and minimize potential costs for the insurer. Option C. Suggest that the consumer's dissatisfaction is likely a result of misunderstanding the policy and encourage them to accept the insurer's decision to avoid further complications. Option D. Advise the consumer to review their policy documents thoroughly and contact the insurer directly for clarification, focusing on the technical interpretation of policy terms. The correct answer is A. Proactively explain the consumer's rights regarding the claim, outline the available internal and external dispute resolution mechanisms, and offer assistance in navigating these processes. Explanation. This scenario is professionally challenging because it requires balancing the insurer's need to manage risk and costs with the consumer's fundamental right to fair treatment and access to appropriate dispute resolution. A mediator must navigate potential information asymmetry and power imbalances inherent in the consumer-insurer relationship, ensuring that consumer protection principles are upheld. Careful judgment is required to identify and address potentially unfair practices without overstepping the mediator's role or misinterpreting regulatory obligations. The correct approach involves proactively identifying and addressing potential unfair practices by clearly explaining the consumer's rights and the available dispute resolution mechanisms. This aligns with the regulatory framework's emphasis on consumer protection, which mandates transparency and fairness in insurance dealings. Specifically, regulations governing insurance mediation typically require intermediaries to act honestly, fairly, and professionally in accordance with the best interests of their clients. Providing clear information about rights and dispute resolution empowers the consumer and fosters trust, thereby preventing potential breaches of regulatory obligations related to unfair commercial practices and ensuring access to justice. An approach that prioritizes the insurer's immediate cost-saving objectives over clear communication of consumer rights would fail to meet regulatory standards. Such an approach could be construed as an unfair commercial practice, as it may mislead or omit crucial information that the consumer needs to make informed decisions or to assert their rights. This directly contravenes the spirit and letter of consumer protection laws designed to prevent exploitation. Another incorrect approach would be to assume the consumer is fully aware of their rights and the dispute resolution process without explicit confirmation. This passive stance neglects the mediator's duty of care and the regulatory expectation of proactive consumer engagement. It risks leaving consumers vulnerable and unable to effectively challenge unfair practices, leading to potential regulatory sanctions for the intermediary. Finally, an approach that focuses solely on the technical aspects of the insurance policy without addressing the consumer's understanding of their rights and recourse mechanisms would be inadequate. While technical accuracy is important, consumer protection extends to ensuring the consumer comprehends their position and options, especially when facing a dispute. The professional decision-making process for similar situations should involve a systematic assessment of the consumer's understanding, a clear articulation of their rights and available dispute resolution pathways, and a commitment to fair and transparent dealings. This requires staying abreast of relevant consumer protection legislation and ethical guidelines, and applying them diligently to each client interaction. Question 6. The analysis reveals that a client has requested a copy of their insurance policy details to be sent directly to a third-party financial advisor who is assisting them with their overall financial planning. The insurance intermediary holds sensitive personal data relating to this client. Which of the following represents the most compliant and ethically sound approach to handling this request? Option A. Inform the client that their data cannot be shared with third parties due to strict confidentiality policies, and advise them to obtain the information themselves. Option B. Share the requested policy details directly with the financial advisor, assuming the client's request implies consent and that financial advisors inherently adhere to professional data protection standards. Option C. Obtain explicit, informed consent from the client for the specific data to be shared with the named financial advisor, verify the financial advisor's identity and data protection credentials, and establish a clear contractual agreement outlining data handling and confidentiality obligations before sharing any information. Option D. Share the policy details with the financial advisor, but only after redacting all sensitive personal information, even if this makes the policy details incomplete for the advisor's purpose. The correct answer is C. Obtain explicit, informed consent from the client for the specific data to be shared with the named financial advisor, verify the financial advisor's identity and data protection credentials, and establish a clear contractual agreement outlining data handling and confidentiality obligations before sharing any information. Explanation. This scenario is professionally challenging because it requires balancing the need to share information for legitimate business purposes with the stringent obligations to protect client data. The Insurance Mediation Certificate Exam jurisdiction emphasizes a robust data protection framework, meaning any deviation can lead to significant regulatory penalties and reputational damage. Careful judgment is required to ensure that data sharing is both necessary and compliant. The correct approach involves a proactive risk assessment and the implementation of appropriate safeguards before any data is shared. This means identifying the specific data required, the purpose for sharing, the recipient's data protection capabilities, and ensuring contractual agreements are in place that mandate confidentiality and data security. This aligns with the core principles of data protection laws, which require data controllers to process data lawfully, fairly, and transparently, and to implement appropriate technical and organizational measures to ensure a level of security appropriate to the risk. Specifically, it addresses the need for a lawful basis for processing and sharing, and the obligation to protect personal data from unauthorized access or disclosure. An incorrect approach that involves sharing data without a clear lawful basis or without assessing the recipient's security measures fails to uphold the duty of care owed to clients. This constitutes a breach of data protection principles, potentially leading to unauthorized disclosure of sensitive personal information. Another incorrect approach, such as assuming consent is implied or relying on outdated consent, is also problematic as data protection laws typically require explicit and informed consent for processing and sharing personal data, especially for purposes beyond the initial agreement. Sharing data based solely on a perceived business advantage without a formal risk assessment or contractual safeguards ignores the fundamental legal and ethical obligations to protect client privacy. Professionals should adopt a decision-making framework that prioritizes data protection. This involves 1. Identifying the data in question and its sensitivity. 2. Determining the lawful basis for processing and sharing. 3. Conducting a thorough risk assessment of the proposed data sharing, including the recipient's security posture. 4. Implementing appropriate contractual safeguards and technical measures. 5. Documenting the entire process and obtaining necessary consents where applicable. This systematic approach ensures compliance and minimizes the risk of data breaches. Question 7. The monitoring system demonstrates that a client, a small construction firm, has recently undertaken a project involving significant excavation near a public footpath. While the firm owner believes they have taken all reasonable precautions, a recent site inspection report highlights potential issues with temporary fencing and signage adequacy. The owner has asked for advice on whether they are likely to be found negligent if an accident occurs. Which of the following approaches best reflects the professional responsibilities of an insurance intermediary in this situation? Option A. Reassure the client that as long as they believe they have taken reasonable precautions, their liability will be minimal, and focus on securing the most cost-effective general liability insurance policy. Option B. Advise the client on the specific legal tests for negligence and causation, and provide a personal assessment of their likelihood of being found liable based on the inspection report. Option C. Inform the client that as an insurance intermediary, you cannot provide legal opinions and advise them to seek independent legal counsel to determine their potential liability. Option D. Explain the general principles of negligence, including duty of care, breach, causation, and damages, and discuss how the issues raised in the inspection report might relate to these principles, recommending appropriate liability insurance coverage. The correct answer is B. Advise the client on the specific legal tests for negligence and causation, and provide a personal assessment of their likelihood of being found liable based on the inspection report. Explanation. This scenario is professionally challenging because it requires an insurance intermediary to assess potential liability arising from a client's actions, specifically concerning negligence and causation, without overstepping their advisory role or providing legal advice. The intermediary must understand the principles of liability to identify potential risks for their client and advise on appropriate insurance coverage, but they must also recognize the boundaries of their professional competence and regulatory permissions. The correct approach involves identifying the factual circumstances that could lead to a claim, assessing whether those circumstances suggest a breach of duty of care, and considering whether that breach could have caused foreseeable harm. This aligns with the regulatory framework for insurance intermediaries, which mandates that they act with integrity and skill, and provide advice that is suitable for their clients' needs. Specifically, understanding negligence, duty of care, breach, causation, damages, is fundamental to advising on liability insurance. The intermediary's role is to facilitate the client's understanding of their potential liabilities and ensure adequate insurance is in place, not to definitively determine legal fault. An incorrect approach would be to provide a definitive legal opinion on whether the client is negligent. This constitutes the unauthorized practice of law and exceeds the scope of an insurance intermediary's license and expertise. It could lead to incorrect advice, misrepresentation of risk, and potential professional indemnity claims against the intermediary. Another incorrect approach is to dismiss potential liability without a thorough review of the facts. This demonstrates a lack of due diligence and a failure to act in the client's best interests. It could result in the client being underinsured for genuine risks, leading to significant financial consequences for the client and reputational damage for the intermediary. A further incorrect approach is to focus solely on the client's stated intentions without considering the objective reality of their actions and their potential impact on third parties. Liability often arises from unintended consequences or failures to meet reasonable standards of care, regardless of good intentions. The professional decision-making process for similar situations should involve 1. Fact-finding, gathering all relevant information about the client's activities and potential interactions with third parties. 2. Risk identification, analyzing the gathered facts to identify potential scenarios where the client's actions could cause harm. 3. Principle application, applying the principles of liability, duty of care, breach, causation, damages, conceptually to these scenarios to understand the nature of the potential risk. 4. Insurance suitability, determining the appropriate types and levels of insurance coverage that would address these identified risks. 5. Clear communication, explaining the identified risks and recommended insurance solutions to the client in clear, understandable terms, while explicitly stating that this is not legal advice. 6. Regulatory adherence, ensuring all advice and actions comply with relevant insurance intermediary regulations. Question 8. The risk matrix shows a client's potential exposure to a fire at their business premises. This event carries a significant financial impact if it occurs, but the likelihood of such an event is considered low. The client is seeking advice on how to manage this exposure. Which of the following approaches best aligns with the principles of risk management and the regulatory obligations of an insurance intermediary? Option A. Suggest that the client invest in a diversified portfolio to offset any potential financial losses from a fire. Option B. Explain that this is a pure risk and recommend exploring appropriate insurance coverage to transfer the financial burden of potential loss. Option C. Focus on strategies to increase the potential financial gain from the business, as this is a speculative risk. Option D. Advise the client that since the likelihood is low, the risk can be accepted and no further action is required. The correct answer is D. Advise the client that since the likelihood is low, the risk can be accepted and no further action is required. Explanation. This scenario is professionally challenging because it requires the insurance intermediary to distinguish between different types of risk and apply appropriate risk management principles within the specific regulatory framework governing insurance mediation. Intermediary must not only understand the theoretical definitions of risk, but also how these concepts translate into practical advice and actions for clients, ensuring compliance with their regulatory obligations. Careful judgment is required to avoid mischaracterizing risks, which could lead to inappropriate product recommendations or inadequate risk mitigation strategies, potentially exposing the client and the intermediary to regulatory sanction. The correct approach involves accurately identifying the type of risk presented by the client's situation and then recommending a risk management strategy that aligns with the client's needs and the regulatory expectations for insurance intermediaries. This typically means distinguishing between pure risks, where there is only a possibility of loss or no loss, and speculative risks, where there is a possibility of gain or loss. For pure risks, insurance is often the most appropriate risk management tool. The regulatory framework for insurance mediation mandates that intermediaries act in the best interests of their clients, provide suitable advice, and ensure that recommended products are appropriate for the client's circumstances. Therefore, correctly classifying the risk is foundational to fulfilling these duties. An incorrect approach that misclassifies a pure risk as speculative and suggests investment, rather than insurance, would fail to meet the client's need for protection against potential loss. This would be a breach of the intermediary's duty to provide suitable advice and act in the client's best interests, as insurance is designed to mitigate pure risks. Furthermore, recommending an investment product for a pure risk scenario could expose the client to unnecessary financial volatility and potential loss, which is contrary to the purpose of insurance. Another incorrect approach that focuses solely on the potential for financial gain from a speculative risk, ignoring the possibility of loss and the client's risk tolerance, would also be a regulatory failure. While speculative risks involve potential gain, they also carry significant downside. An insurance intermediary's role is to help clients manage risk, which includes understanding and mitigating potential losses, not solely pursuing gains. This approach would neglect the fundamental principle of risk management and potentially lead to unsuitable advice. A third incorrect approach that suggests ignoring a pure risk because the probability of loss is low would be a direct contravention of the intermediary's duty to advise on appropriate risk management. Even low-probability events can have catastrophic consequences, and insurance exists precisely to provide financial protection against such events. Failing to advise on insurance for a pure risk, regardless of its perceived likelihood, would be a failure to provide comprehensive risk management advice and could leave the client uninsured against significant potential losses. The professional decision-making process for similar situations should involve a structured approach. First, thoroughly understanding the client's situation and objectives. Second, identifying and classifying the risks involved, distinguishing between pure and speculative risks. Third, evaluating the client's risk appetite and tolerance. Fourth, considering the available risk management techniques, including insurance, avoidance, retention, and reduction. Fifth, recommending the most suitable strategy based on the client's needs and regulatory requirements. And finally, documenting the advice provided and the rationale behind it. Question 9. Operational review demonstrates that a client, a chemical manufacturing and distribution company, is primarily concerned about potential damage to its factory and inventory from fire or natural disasters. They have requested a quote for insurance coverage. Which of the following insurance product recommendations best addresses the client's overall risk profile, considering their industry and operations? Option A. A general liability insurance policy covering third-party claims arising from the company's operations. Option B. Life and health insurance policies for the company's key executives and employees. Option C. A comprehensive package including property insurance for the factory and inventory, alongside product liability insurance and environmental liability insurance. Option D. A property insurance policy covering the factory and inventory against fire and natural disasters. The correct answer is C. A comprehensive package including property insurance for the factory and inventory, alongside product liability insurance and environmental liability insurance. Explanation. This scenario is professionally challenging because it requires the insurance intermediary to accurately identify the core risk exposure of a client and match it with the most appropriate insurance product, considering the client's specific business operations and potential liabilities. Misclassifying the insurance need can lead to significant underinsurance, financial loss for the client, and potential regulatory breaches for the intermediary. Careful judgment is required to move beyond superficial descriptions of the business and delve into the underlying risks. The correct approach involves recognizing that a business involved in manufacturing and distributing potentially hazardous chemicals faces not only property damage risks, but also significant liability risks arising from product defects, environmental contamination, and workplace accidents. Therefore, a comprehensive insurance program that includes both property insurance for physical assets and robust casualty insurance, specifically product liability and environmental liability coverage, is essential. This aligns with the regulatory expectation that intermediaries act in the best interests of their clients by providing advice that adequately addresses their identified risks. An incorrect approach that focuses solely on property insurance fails to acknowledge the substantial liability exposures inherent in the client's operations. This would leave the client exposed to claims that could cripple their business, representing a failure to provide adequate advice and potentially violating the duty of care owed to the client. Another incorrect approach that suggests only general liability insurance overlooks the specific risks associated with chemical manufacturing and distribution, such as product defects leading to harm or environmental damage. This demonstrates a lack of understanding of specialized liability coverages and their importance for this particular industry. A further incorrect approach that proposes only life and health insurance for the business owners, while important for personal financial planning, completely misses the core business risk exposures that require commercial insurance. This highlights a fundamental misunderstanding of the client's commercial insurance needs. Professionals should employ a decision-making framework that begins with a thorough risk assessment of the client's business. This involves understanding their industry, operations, products, and potential exposures. Based on this assessment, the intermediary should then identify the most suitable types of insurance coverage, considering the specific risks and the client's financial capacity. Regulatory requirements and ethical obligations mandate that advice provided is tailored, comprehensive, and prioritizes the client's protection against foreseeable risks. Question 10. Benchmark analysis indicates that an individual approaches an insurance intermediary seeking to purchase a comprehensive home insurance policy. The individual expresses a strong desire for coverage and is willing to pay the premium. The intermediary provides a standard policy document outlining the terms and conditions, and the individual signs it, stating they understand the document. The premium is subsequently paid. Which of the following best describes the status of the contract if the intermediary later discovers the individual is a minor and the property being insured is being used for an illegal gambling operation? Option A. The contract is likely valid as long as the insurance company is willing to provide coverage, as their acceptance is the primary determinant. Option B. The contract is likely voidable due to the lack of legal capacity of one of the parties and the illegality of the contract's purpose. Option C. The contract is likely valid because the premium was paid and the policy document was signed, indicating mutual agreement. Option D. The contract is likely valid because the individual expressed a clear intention to be insured and the intermediary provided the policy. The correct answer is C. The contract is likely valid because the premium was paid and the policy document was signed, indicating mutual agreement. Explanation. This scenario is professionally challenging because it requires the insurance intermediary to navigate the fundamental principles of contract law within the specific regulatory framework governing insurance mediation. Misinterpreting or overlooking any of the essential elements of a valid contract can lead to the invalidation of an insurance policy, resulting in significant financial and reputational damage for both the client and the intermediary. The intermediary must exercise careful judgment to ensure all contractual requirements are met to protect the interests of all parties involved and maintain compliance with regulatory obligations. The correct approach involves identifying whether all 5 essential elements of a valid contract offer, acceptance, consideration, capacity, and legality, are present and clearly demonstrable in the proposed insurance agreement. This approach is right because it directly addresses the legal prerequisites for a binding contract. Under the regulatory framework for insurance mediation, intermediaries have a duty of care and a responsibility to ensure that the products they facilitate are legally sound and that clients understand the contractual nature of the insurance policy. Demonstrating the presence of offer, acceptance, consideration, capacity, and legality ensures that the policy is enforceable and that the intermediary has fulfilled their professional and regulatory obligations. An incorrect approach would be to assume a contract exists solely because a premium has been paid and a policy document has been issued. This fails to acknowledge that the payment of a premium is consideration, but it does not in itself constitute a valid offer or acceptance, nor does it confirm the capacity of the parties or the legality of the contract's purpose. This approach risks overlooking fundamental defects that could render the policy void from inception. Another incorrect approach would be to focus only on the client's stated desire for insurance coverage. While a client's intention is important, it does not automatically translate into a legally binding offer or acceptance. The intermediary must ensure there is a clear proposal offer from one party and a clear, unqualified agreement acceptance from the other, supported by consideration. Without these, the client's desire, however strong, does not form a contract. A further incorrect approach would be to overlook the legality of the insurance coverage being sought. If the purpose of the insurance is illegal or against public policy, the contract will be void regardless of whether other elements are present. The intermediary has a responsibility to ensure that the insurance being mediated is for a legitimate and lawful purpose. A professional reasoning process for similar situations should involve a systematic review of the core elements of contract formation. Intermediaries should ask, is there a clear offer? Has it been unequivocally accepted? Is there valid consideration exchanged between the parties? Do both parties have the legal capacity to enter into a contract? Is the purpose and subject matter of the contract legal and not contrary to public policy? By addressing these questions, professionals can proactively identify potential issues and ensure the integrity and enforceability of insurance contracts. Question 11. Consider a scenario where an insurance mediator, who is about to commence a mediation between an insurance company and a policyholder, discovers that they have a significant, ongoing financial investment in a separate, unrelated company that is a major supplier to the insurance company involved in the mediation. The mediator has not previously disclosed this investment to either party. What is the most ethically and regulatorily sound course of action for the mediator? Option A. Continue with the mediation but make a general statement at the outset about being an independent mediator without specifically mentioning the financial investment. Option B. Proceed with the mediation, confident that the financial investment is unrelated to the specific dispute and therefore does not pose a conflict of interest. Option C. Immediately disclose the financial investment to both the insurance company and the policyholder, and offer to withdraw from the mediation if either party expresses any concerns about proceeding. Option D. Inform the insurance company privately about the financial investment and seek their assurance that they are comfortable with the mediator proceeding, without informing the policyholder. The correct answer is B. Proceed with the mediation, confident that the financial investment is unrelated to the specific dispute and therefore does not pose a conflict of interest. Explanation. This scenario presents a professional challenge due to the inherent conflict of interest that arises when a mediator has a pre-existing financial relationship with one of the parties involved in the dispute. The Insurance Mediation Certificate Framework, as per UK regulations and CISI guidelines, places a strong emphasis on impartiality and the avoidance of situations that could compromise a mediator's objectivity. Maintaining public trust in the mediation process is paramount, and any perception of bias, whether actual or potential, can undermine this trust. Careful judgment is required to identify and manage such conflicts effectively, ensuring that the mediation process remains fair and equitable for all participants. The correct approach involves immediate and full disclosure of the pre-existing financial relationship to all parties involved in the mediation, along with the offer to withdraw from the case if any party expresses concerns. This approach aligns directly with the ethical standards for mediators as outlined by CISI, which mandate transparency and the proactive management of conflicts of interest. By disclosing the relationship, the mediator upholds the principle of informed consent, allowing the parties to make an informed decision about whether they are comfortable proceeding with the mediation under these circumstances. The offer to withdraw demonstrates a commitment to impartiality and prioritizes the integrity of the mediation process over personal gain or convenience. This proactive disclosure and willingness to step aside are crucial for maintaining the mediator's professional integrity and adhering to regulatory expectations. An incorrect approach would be to proceed with the mediation without disclosing the financial relationship. This failure to disclose is a direct violation of ethical standards requiring transparency and honesty, creates a significant risk of perceived or actual bias, undermining the fairness of the process, and potentially leading to a challenge of the mediation's outcome. Another incorrect approach would be to disclose the relationship, but insist on continuing the mediation without offering to withdraw. While disclosure is a step in the right direction, failing to offer withdrawal when a potential conflict exists can still leave parties feeling pressured or that their concerns are not being adequately addressed, thus failing to fully mitigate the conflict and uphold the highest ethical standards of impartiality. A further incorrect approach would be to downplay the significance of the financial relationship to the parties. This misrepresentation of the conflict's potential impact is unethical and deceptive, eroding trust and failing to provide parties with the necessary information to make a truly informed decision. The professional decision-making process for similar situations should involve a systematic evaluation of potential conflicts of interest. This begins with identifying any existing or potential relationships that could influence the mediator's objectivity. Following identification, the mediator must assess the nature and significance of the conflict. The paramount principle is always transparency. Therefore, immediate and full disclosure to all parties is the mandatory first step. This disclosure must be accompanied by an offer to withdraw, empowering the parties to decide if they wish to proceed. If parties agree to proceed, the mediator must remain vigilant and ensure their conduct throughout the mediation is demonstrably impartial. If at any point the conflict appears unmanageable or compromises the integrity of the process, withdrawal is the only ethically sound course of action. Question 12. Risk assessment procedures indicate that a client wishes to insure a 5-year-old piece of equipment for the full cost of a brand new replacement, arguing that this is the only way they will feel adequately protected in the event of a total loss. Which of the following approaches best upholds the principles of insurance and regulatory requirements for an insurance intermediary? Option A. Arrange the insurance coverage as requested, ensuring the client receives the full cost of a new replacement item, as this meets their stated desire for protection. Option B. Advise the client that insurance is designed to indemnify them against loss, meaning it should restore them to their pre-loss financial position, and propose coverage based on the item's current market value or depreciated value, explaining the principle of indemnity. Option C. Inform the client that their request is unreasonable and refuse to arrange any coverage for the equipment. Option D. Proceed with the requested coverage, but make a note in the file that the client insisted on this arrangement, without further explanation to the client. Correct answer is B. Advise the client that insurance is designed to indemnify them against loss, meaning it should restore them to their pre-loss financial position, and propose coverage based on the item's current market value or depreciated value, explaining the principle of indemnity. Explanation. This scenario is professionally challenging because it requires the insurance intermediary to balance the client's immediate perceived needs with the fundamental principles of insurance, specifically the principle of indemnity. The intermediary must ensure that the proposed insurance solution does not lead to the client profiting from a loss, which would undermine the core purpose of insurance. Careful judgment is required to identify and address potential misalignments between the client's expectations and the principles of sound insurance practice. The correct approach involves advising the client that the proposed insurance coverage, which aims to replace an item with a new one of equivalent value regardless of its age or condition, would violate the principle of indemnity. This principle dictates that insurance should restore the insured to the financial position they were in before the loss, not place them in a better position. By explaining this principle and suggesting alternative coverage that reflects the item's current market value or depreciated value, the intermediary upholds their ethical and regulatory duty to provide suitable advice. This aligns with the regulatory framework's emphasis on consumer protection and ensuring that insurance products are appropriate for the client's needs and circumstances, preventing misrepresentation and unfair practices. An incorrect approach would be to agree to arrange coverage that allows the client to receive the full cost of a new item, even if the insured item was old or used. This fails to uphold the principle of indemnity, potentially leading to the client profiting from a claim, which is contrary to the spirit and purpose of insurance. Such an action could be seen as facilitating an unfair or misleading transaction, breaching regulatory requirements related to suitability and consumer detriment. Another incorrect approach would be to simply dismiss the client's request without a thorough explanation or offering alternatives. This demonstrates a lack of professional diligence and customer service, failing to educate the client on the principles of insurance and potentially damaging the intermediary-client relationship. While not directly violating indemnity, it falls short of the expected standard of advice and guidance. A further incorrect approach would be to proceed with the requested coverage without fully understanding the implications or without clearly documenting the client's understanding of the potential issues. This could lead to disputes during a claim and expose both the client and the intermediary to regulatory scrutiny for inadequate advice and record keeping. The professional decision-making process for similar situations should involve 1. Understanding the client's stated needs and objectives. 2. Assessing these needs against the fundamental principles of insurance. 3. Identifying any potential conflicts or misalignments. 4. Clearly explaining the relevant principles and their implications to the client. 5. Proposing suitable and compliant insurance solutions that meet the client's genuine needs without violating core insurance principles. 6. Documenting all advice and client decisions. Question 13. The risk matrix shows a moderate likelihood of a client misunderstanding complex policy terms, leading to potential dissatisfaction and complaints. A client, Mr. Smith, is seeking life insurance to cover a mortgage. He expresses a desire for the lowest possible monthly premium. You have identified two suitable products. Product A, which has a slightly higher premium but offers clearer policy wording and fewer exclusions, and Product B, which has the lowest premium but includes several complex clauses and a higher number of specific exclusions that could impact coverage. Which of the following actions best demonstrates adherence to regulatory requirements and ethical best practice in this scenario? Option A. Recommend Product B and highlight its low premium, while briefly mentioning that there are some exclusions but not elaborating on their nature or potential impact. Option B. Recommend Product B due to its lower premium, as this directly addresses Mr. Smith's stated primary concern. Option C. Recommend Product A, clearly explaining that while the premium is slightly higher, its simpler terms and fewer exclusions offer better long-term value and reduce the risk of future misunderstandings, aligning with his need for mortgage protection. Option D. Provide Mr. Smith with brochures for both products and allow him to make the final decision without further detailed explanation of the differences in exclusions and policy wording. The correct answer is B. Recommend Product B due to its lower premium, as this directly addresses Mr. Smith's stated primary concern. Explanation. This scenario is professionally challenging because it requires the insurance intermediary to balance the client's immediate financial needs with their long-term suitability for a particular insurance product, all while adhering to strict regulatory obligations regarding advice and disclosure. The intermediary must act in the client's best interest, which involves a thorough understanding of the client's circumstances and the product's features, benefits, and risks. The correct approach involves the intermediary conducting a comprehensive needs analysis and suitability assessment before recommending any product. This includes understanding the client's financial situation, risk tolerance, objectives, and existing insurance coverage. The intermediary must then explain the recommended product's features, benefits, exclusions, and costs clearly and concisely, ensuring the client understands the implications. This aligns with the regulatory framework's emphasis on consumer protection, fair treatment of customers, and the requirement for intermediaries to provide advice that is appropriate to the client's circumstances. Specifically, regulations often mandate that advice must be suitable and that all relevant information must be disclosed to enable an informed decision. An incorrect approach would be to prioritize the immediate sale or commission over the client's actual needs. For instance, recommending a product that offers a higher commission to the intermediary, even if it is not the most suitable for the client, constitutes a breach of fiduciary duty and regulatory requirements. This fails to uphold the principle of acting in the client's best interest and can lead to mis-selling, resulting in financial harm to the client and regulatory sanctions for the intermediary. Another incorrect approach is to provide a superficial needs analysis, failing to probe deeply into the client's circumstances, or to present product information in a way that is misleading or omits crucial details. This undermines the client's ability to make an informed decision and violates disclosure obligations. Professionals should employ a structured decision-making process that begins with a thorough understanding of the client's profile and objectives. This should be followed by a diligent product research and comparison phase, ensuring the intermediary has a deep understanding of the available options. The recommendation phase must be client-centric, transparent, and well-documented, with clear explanations of why a particular product is suitable. Finally, ongoing client relationship management, including periodic reviews, is crucial to ensure the product remains appropriate as the client's circumstances evolve. Question 14. Quality control measures reveal a recorded client interaction where a policyholder, Mr. Davies, is expressing significant frustration and anger regarding a recent claim denial. He believes the denial is unfair and is raising his voice, using accusatory language, and demanding an immediate reversal of the decision. The insurance intermediary, Sarah, is on the call. Which of the following responses best demonstrates effective conflict resolution and adherence to professional conduct? Option A. Sarah agrees to override the claim denial immediately to appease Mr. Davies, assuring him that she will sort it out without verifying the policy details or the grounds for denial. Option B. Sarah immediately becomes defensive, interrupts Mr. Davies to explain that the decision was made by the underwriting department and is final, and tells him he is being unreasonable. Option C. Sarah tells Mr. Davies that she cannot help him and that he should have read his policy documents more carefully, then ends the call abruptly. Option D. Sarah calmly acknowledges Mr. Davies' frustration, validates his feelings by saying she understands why he is upset, and then clearly and patiently explains the specific policy clauses that led to the claim denial, offering to review the documentation with him and outlining the formal appeals process available. The correct answer is D. Sarah calmly acknowledges Mr. Davies' frustration, validates his feelings by saying she understands why he is upset, and then clearly and patiently explains the specific policy clauses that led to the claim denial, offering to review the documentation with him and outlining the formal appeals process available. Explanation: this scenario is professionally challenging because it requires the insurance intermediary to navigate a highly emotional and potentially confrontational situation while upholding their professional and ethical obligations. The intermediary must balance the client's distress with the need to adhere to regulatory requirements and maintain a professional demeanor. The core challenge lies in de-escalating the situation without compromising the integrity of the advice or the regulatory framework. The correct approach involves actively listening, acknowledging the client's feelings, and calmly explaining the regulatory constraints and available options. This demonstrates empathy and professionalism, which are crucial for maintaining client trust and fulfilling the intermediary's duty of care. Specifically, under the regulatory framework for insurance mediation, intermediaries are obligated to act honestly, fairly, and professionally in accordance with the best interests of their clients. This includes managing client expectations realistically and communicating clearly about policy terms and conditions, even when the client is upset. De-escalation techniques, such as using a calm tone, avoiding jargon, and focusing on solutions, are essential for effective communication and conflict resolution, aligning with the principles of good conduct expected of regulated professionals. An incorrect approach that involves becoming defensive or argumentative would escalate the conflict and damage the client relationship, would also fail to address the client's underlying concerns, and could be seen as unprofessional conduct, potentially breaching regulatory requirements for fair treatment of customers. Another incorrect approach, such as immediately agreeing to the client's demands without proper assessment or consideration of policy terms and regulatory obligations, would be irresponsible and could lead to misrepresentation or breaches of contract. This would violate the intermediary's duty to provide accurate and compliant advice. A further incorrect approach, such as dismissing the client's concerns or becoming overly emotional in response, would be unprofessional and counterproductive. It would fail to de-escalate the situation and could lead to a breakdown in communication, potentially resulting in a formal complaint or regulatory action. The professional decision-making process for similar situations should involve 1. Remaining calm and composed. 2. Actively listening to understand the client's perspective and emotions. 3. Empathizing with the client's situation without necessarily agreeing with their conclusions. 4. Clearly and calmly explaining the relevant policy terms, regulatory requirements, and available options. 5. Focusing on finding a resolution within the established framework. 6. Documenting the interaction and any agreed-upon actions. Question 15. The assessment process reveals that a new firm intends to offer services that involve introducing potential clients to insurance providers and facilitating the initial stages of the insurance application process. The firm's directors believe that because they are not directly advising on policy terms or underwriting, and are partnering with an FCA-authorized insurance broker for the final stages of the sale, they do not require their own direct authorization as an insurance intermediary. They are relying on the fact that their activities are limited to lead generation and initial data gathering. Which of the following best reflects the regulatory approach required for this firm under the UK regulatory framework? Option A. The firm must obtain full FCA authorization as an insurance intermediary because its activities, even if limited, constitute regulated activities of arranging or facilitating the introduction to insurance contracts, and reliance on a partner firm does not negate the need for its own authorization if it performs regulated functions. Option B. The firm should register with a trade body relevant to its primary business, as this will provide sufficient oversight for its introductory insurance activities. Option C. The firm's activities are considered ancillary to its primary business and therefore exempt from direct FCA authorization, provided the insurance mediation is not the main focus of its business. Option D. The firm can operate without direct FCA authorization as long as it has a clear contractual agreement with an authorized insurance broker, and the broker assumes full responsibility for all regulated activities. The correct answer is A. The firm must obtain full FCA authorization as an insurance intermediary because its activities, even if limited, constitute regulated activities of arranging or facilitating the introduction to insurance contracts, and reliance on a partner firm does not negate the need for its own authorization if it performs regulated functions. Explanation: this scenario presents a professional challenge because it requires a nuanced understanding of the regulatory framework governing insurance mediation in the UK, specifically concerning licensing requirements. The challenge lies in distinguishing between activities that necessitate a full intermediary authorization and those that might fall under an exemption or a different regulatory category. Misinterpreting these distinctions can lead to significant regulatory breaches, including operating without the appropriate authorization, which carries severe penalties. Careful judgment is required to ensure compliance with the Financial Conduct Authority (FCA) handbook, particularly the Conduct of Business Sourcebook (COBS) and the Authorization Sourcebook (AUTH). The correct approach involves a thorough assessment of the specific services being offered to determine if they constitute regulated activities under the Financial Services and Markets Act 2000 FSMA. If the services involve advising on, arranging, or mediating in the sale of insurance contracts and do not fall under a clear exemption, then obtaining the appropriate FCA authorization as an insurance intermediary is mandatory. This ensures that the firm adheres to the stringent conduct rules, capital requirements, and consumer protection measures mandated by the FCA, thereby upholding market integrity and consumer confidence. An incorrect approach would be to assume that any activity related to insurance automatically falls under a general business exemption, or that a partnership with an authorized firm absolves the entity of its own regulatory obligations. Operating without the necessary authorization is a direct contravention of FSMA and FCA rules. This failure to secure proper authorization means the firm is not subject to the oversight and regulatory standards designed to protect consumers and maintain market stability. Furthermore, misinterpreting the scope of exemptions, such as those for ancillary insurance mediation, can lead to unintentional breaches. For instance, offering advice on insurance products beyond what is strictly incidental to the main business activity would likely trigger authorization requirements. The professional decision-making process for similar situations should involve a systematic review of the proposed business activities against the FCA's regulatory perimeter. This includes consulting the FCA handbook, seeking professional legal or compliance advice when in doubt, and clearly documenting the rationale for any decision regarding regulatory status. A proactive approach to understanding and adhering to regulatory requirements is paramount to avoid penalties and maintain a reputable business operation. Question 16. Benchmark analysis indicates that when interpreting a specific clause within an insurance contract that appears to have multiple plausible meanings, what is the most appropriate course of action for an insurance intermediary to ensure compliance with regulatory obligations and best serve the client's interests? Option A. Proceed with the policy as is, considering the ambiguity minor and unlikely to impact a claim significantly. Option B. Accept the client's initial interpretation of the clause without further investigation, as their understanding is paramount. Option C. Thoroughly review the clause within the full policy context and seek clarification from the insurer if ambiguity persists. Option D. Rely on the most common industry interpretation of the clause, assuming it reflects the policy's intent. The correct answer is D. Rely on the most common industry interpretation of the clause, assuming it reflects the policy's intent. Explanation: scenario analysis. This scenario is professionally challenging because it requires the insurance intermediary to navigate potential ambiguity in an insurance contract's wording. The core challenge lies in interpreting a clause that could have multiple reasonable meanings, and the intermediary must act in the client's best interest while adhering to regulatory obligations regarding fair treatment and accurate representation. Misinterpretation could lead to the client being underinsured or facing unexpected claim denials, resulting in financial loss and reputational damage for the intermediary. Correct approach analysis. The correct approach involves a thorough review of the policy wording, considering the context of the entire contract, and seeking clarification from the insurer if ambiguity persists. This aligns with the regulatory requirement for insurance intermediaries to act with integrity and skill, ensuring clients understand the terms and conditions of their insurance. Specifically, under the Insurance Distribution Directive (IDD), in the UK, intermediaries have a duty to provide clear, fair, and not misleading information. Seeking clarification from the insurer demonstrates due diligence and a commitment to accurate advice, thereby upholding the client's best interests and regulatory compliance. Incorrect approaches analysis. One incorrect approach is to rely solely on a common understanding or industry jargon without verifying the precise contractual definition. This fails to meet the regulatory standard of providing accurate information and could lead to misrepresentation if the common understanding differs from the policy's specific terms. Neglects the intermediary's duty to ensure the client fully comprehends the contract's implications. Another incorrect approach is to assume the client's interpretation is correct without independent verification or seeking insurer clarification. While client understanding is important, the intermediary's professional responsibility is to ensure that understanding is based on the actual policy terms, not just the client's perception. This approach risks perpetuating a misunderstanding that could have serious consequences at the time of a claim. A third incorrect approach is to dismiss the ambiguity as minor and proceed without further investigation, believing it unlikely to affect a claim. This is a failure of professional diligence. Insurance contracts are legal documents, and even seemingly minor ambiguities can have significant implications for coverage. The intermediary's role is to identify and address such issues proactively to protect the client. Professional reasoning. Professionals should adopt a systematic approach to policy interpretation. This involves 1. Reading the relevant clause carefully in isolation. 2. Reading the clause in the context of the entire policy document, including definitions and other related clauses. 3. Considering the purpose of the insurance and the likely intent of the parties. 4. If ambiguity remains, proactively seeking written clarification from the insurer. 5. Communicating the clarified position clearly to the client, ensuring they understand the implications. This process ensures compliance with regulatory duties of care, transparency, and acting in the client's best interests. Question 17. Quality control measures reveal that an insurance mediator has consistently proposed mediation for all incoming disputes, including those involving allegations of deliberate misrepresentation by the policyholder and complex coverage disputes arising from novel technological risks. The mediator's rationale is that mediation offers a less adversarial approach. Which of the following best describes the types of insurance disputes that are generally most suitable for mediation under typical regulatory frameworks governing insurance mediation? Option A. Disputes where one party has clearly acted in bad faith and the other party is seeking punitive damages, as mediation can expedite the process of assigning blame. Option B. Disputes involving straightforward interpretation of policy terms. Quantum of claims where liability is not in dispute, and disagreements over the extent of damage, provided both parties are willing to engage in a facilitated negotiation. Option C. Disputes concerning the interpretation of new and complex legal precedents related to emerging technologies, where a definitive legal ruling is required. Option D. Disputes where fraud is alleged, as mediation can uncover hidden motives and facilitate admissions of guilt. The correct answer is B. Disputes involving straightforward interpretation of policy terms, quantum of claims where liability is not in dispute, and disagreements over the extent of damage, provided both parties are willing to engage in a facilitated negotiation. Explanation. This scenario presents a professional challenge, because it requires the insurance mediator to exercise sound judgment in identifying disputes that are genuinely suitable for mediation, aligning with the principles of efficient dispute resolution and regulatory expectations. The challenge lies in distinguishing between disputes where mediation offers a viable path to resolution and those where it might be inappropriate or ineffective, potentially leading to wasted time and resources for all parties involved. The correct approach involves recognizing that mediation is most effective for disputes where there is a willingness from both parties to engage in a facilitated negotiation, where the issues are primarily factual or involve differing interpretations of policy terms, and where a mutually agreeable solution is possible. This aligns with the regulatory framework for insurance mediation, which emphasizes promoting fair and efficient resolution of disputes. Specifically, the Insurance Mediation Directive, or equivalent local regulation, often promotes alternative dispute resolution (ADR) mechanisms like mediation for consumer complaints and straightforward policy disputes, provided they do not involve complex legal novelties or require definitive legal precedent. The ethical duty of a mediator is to facilitate a process that is fair and efficient, and this includes assessing the suitability of mediation for the specific dispute. An incorrect approach would be to universally apply mediation to all types of insurance disputes, regardless of their complexity or the parties' willingness to participate. For instance, attempting to mediate a dispute involving allegations of fraud or a highly complex legal interpretation of a novel insurance product would likely be unproductive. Fraud cases often require a formal investigation and potentially legal proceedings to establish facts and intent, which mediation is not designed to undertake. Similarly, disputes requiring a definitive legal ruling on a new or ambiguous area of law are better suited for adjudication or arbitration, where a binding decision can be made. Pushing for mediation in such cases would be a failure to exercise professional judgment, potentially leading to a breakdown of trust and a failure to achieve resolution, thereby contravening the spirit of efficient dispute resolution promoted by regulatory bodies. Another incorrect approach would be to dismiss mediation for disputes where there is a clear willingness from both parties to explore settlement, and where the issues are primarily about the quantum of a claim or the application of standard policy terms. This would represent a missed opportunity for a cost-effective and timely resolution, potentially frustrating consumers and failing to uphold the mediator's role in facilitating accessible dispute resolution. The professional decision-making process for similar situations should involve a thorough initial assessment of the dispute. This includes understanding the nature of the claim, the parties' stated positions, their apparent willingness to negotiate, and the potential for a mutually acceptable outcome. Mediators should be aware of the limitations of mediation and when other dispute resolution mechanisms might be more appropriate. They should also consider the regulatory guidance on the types of disputes suitable for mediation, ensuring their practice aligns with promoting fair and efficient outcomes for consumers and insurers alike. Question 18. The control framework reveals that during an insurance mediation session, one party becomes visibly distressed, expressing frustration and near tears. The mediator's primary duty is to facilitate a resolution while remaining impartial. What is the most appropriate immediate course of action for the mediator? Option A. Offer personal reassurance and advice to the distressed party, validating their feelings and suggesting a potential course of action. Option B. Immediately end the mediation session and advise the distressed party to seek independent legal advice. Option C. Offer the distressed party a brief pause to compose themselves, then gently guide the conversation back to the mediation process in a neutral and supportive manner. Option D. Continue with the planned agenda, ignoring the party's emotional state to maintain the session's momentum. The correct answer is C. Offer the distressed party a brief pause to compose themselves, then gently guide the conversation back to the mediation process in a neutral and supportive manner. Explanation. Scenario analysis. This scenario presents a common challenge in insurance mediation, where a mediator must navigate a situation where a party's emotional state could potentially compromise the fairness and effectiveness of the mediation process. The mediator's responsibility to remain impartial and facilitate a constructive dialogue is tested when one party exhibits significant distress, which could lead to them making decisions they might later regret or feeling coerced. The challenge lies in balancing empathy with the strict requirement of neutrality, ensuring that the mediator does not inadvertently influence the outcome or create an environment where one party feels disadvantaged due to their emotional state. Correct approach analysis. The correct approach involves acknowledging the party's distress, offering a brief pause for them to compose themselves, and then gently redirecting the conversation back to the mediation process in a neutral and supportive manner. This approach upholds the mediator's duty of impartiality by not taking sides or offering personal advice. It also respects the party's autonomy and ensures they are in a suitable state to participate meaningfully. This aligns with the principles of effective mediation, which require a calm and rational environment for parties to explore solutions. The regulatory framework for insurance mediation emphasizes the mediator's role in facilitating communication and ensuring a fair process, which includes managing the dynamics of the mediation session appropriately. Incorrect approaches analysis. One incorrect approach is to immediately cease the mediation and advise the distressed party to seek legal counsel. While offering advice is generally outside a mediator's remit, prematurely ending the session without attempting to manage the situation can be seen as abandoning the mediation process and failing to facilitate. It can also be perceived as the mediator being unable to handle the complexities of a mediation, potentially disadvantaging the parties who sought the mediator's assistance. Another incorrect approach is to offer personal reassurance and advice to the distressed party, attempting to comfort them by agreeing with their perspective or suggesting what they should do. This directly violates the principle of impartiality. By offering personal opinions or aligning with one party's emotional state, the mediator loses their neutral standing, which is fundamental to the integrity of the mediation process and the trust placed in the mediator by all parties. This can lead to a perception of bias and undermine the legitimacy of any agreement reached. A further incorrect approach is to ignore the party's distress and continue with the agenda as if nothing has happened. This demonstrates a lack of professional judgment and empathy, failing to acknowledge the human element of the dispute. It can exacerbate the distressed party's feelings of being unheard or unsupported, potentially leading to an unproductive or even acrimonious session, and failing to uphold the mediator's responsibility to facilitate a constructive dialogue. Professional reasoning. Professionals should approach such situations by first recognizing the emotional cues. The decision-making process involves assessing the impact of the emotion on the mediation's progress and fairness. The mediator should consider their core duties: impartiality, neutrality, confidentiality, and facilitation. The primary goal is to maintain a balanced process. If emotions are high, a brief, neutral pause can be effective. If the distress is severe and persistent, and attempts to manage it neutrally fail, then exploring options like a longer break or rescheduling might be considered, but always with the aim of returning to a facilitated, impartial process. The mediator must constantly self-monitor their own reactions and ensure their actions are in service of the mediation's objectives, not personal comfort or opinion. Question 19. Process analysis reveals that a client, who is a close friend of the owner of a valuable antique car, wishes to take out an insurance policy on that car. The client states they are like family to the owner and feel a strong personal connection to the car, expressing a desire to protect it from damage or theft. The client has no financial stake in the car and would not suffer any direct financial loss if it were damaged or stolen. As an insurance intermediary, what is the most appropriate course of action? Option A. Advise the client to find a way to establish a nominal financial interest in the car, such as a small loan to the owner, to create an insurable interest. Option B. Inform the client that while they don't have a direct insurable interest, their close relationship might be sufficient to satisfy the requirement in this specific case. Option C. Explain to the client that an insurable interest is a legal requirement for a valid insurance contract, meaning they must stand to suffer a direct financial loss if the insured event occurs, and therefore, they cannot insure the car in this scenario. Option D. Proceed with arranging the insurance policy as requested by the client, given their strong personal connection and desire to protect the car. The correct answer is C. Explain to the client that an insurable interest is a legal requirement for a valid insurance contract, meaning they must stand to suffer a direct financial loss if the insured event occurs, and therefore, they cannot insure the car in this scenario. Explanation. This scenario presents a professional challenge because it requires the insurance intermediary to navigate a situation where a client's personal relationship might cloud their judgment regarding the necessity of an insurable interest. The intermediary must uphold regulatory requirements and ethical standards, even when a client expresses a strong personal desire to insure an asset. The core of the challenge lies in distinguishing between a genuine insurable interest, which is a legal requirement for a valid insurance contract, and a sentimental or speculative desire to insure something. The correct approach involves clearly explaining to the client that an insurable interest is a fundamental legal requirement for an insurance policy to be valid. This means the policyholder must stand to suffer a direct financial loss if the insured event occurs. The intermediary must educate the client on the definition and requirements of insurable interest as stipulated by the relevant regulatory framework for the insurance mediation certificate. This approach is correct because it prioritizes regulatory compliance and ethical conduct, ensuring that the intermediary does not facilitate the creation of an invalid or potentially fraudulent insurance contract. By adhering to the legal definition of insurable interest, the intermediary protects both the client and the insurer and upholds the integrity of the insurance market. An incorrect approach would be to proceed with arranging the insurance policy simply because the client insists, without verifying the existence of a legal insurable interest. This failure to assess and confirm insurable interest is a direct contravention of regulatory obligations. It could lead to the policy being void from inception, leaving the client unprotected and potentially facing legal repercussions. Another incorrect approach is to downplay the importance of insurable interest or to suggest ways to circumvent the requirement. This demonstrates a lack of professional integrity and a disregard for the law, potentially exposing the intermediary to disciplinary action, fines, and reputational damage. A third incorrect approach is to assume that a close personal relationship automatically constitutes an insurable interest, without examining the specific financial loss the client would incur. This misinterpretation of the legal concept can lead to the issuance of invalid policies. Professionals in this situation should employ a decision-making framework that begins with a thorough understanding of the regulatory definition of insurable interest. They should then engage in open and honest communication with the client, explaining the legal requirements clearly and patiently. If doubt remains about the existence of an insurable interest, the intermediary should seek clarification from their compliance department or supervisor, or advise the client to seek independent legal advice. The paramount consideration must always be adherence to the law and ethical principles, rather than client convenience or personal sentiment. Question 20. Operational review demonstrates that a client, a small business owner operating from a property located in a known floodplain, is seeking standard business interruption insurance. The client explicitly states they do not want any additional coverage beyond the basic policy, believing it to be sufficient. The insurance intermediary has identified that standard business interruption policies typically exclude or severely limit coverage for losses directly attributable to flooding. What is the most appropriate course of action for the insurance intermediary? Option A. Inform the client that flood insurance is a separate product and that the intermediary can only offer the requested standard business interruption policy. Option B. Advise the client that the standard business interruption policy will likely not cover flood-related losses and recommend a specialized flood insurance policy, explaining the benefits and limitations of both options. Option C. Proceed with the standard business interruption policy as requested by the client, assuming the client understands their risk and has made an informed decision. Option D. Suggest that the client review the policy wording carefully to determine if any flood coverage is implicitly included in the standard policy. The correct answer is B. Advise the client that the standard business interruption policy will likely not cover flood-related losses and recommend a specialized flood insurance policy, explaining the benefits and limitations of both options. Explanation. This scenario presents a professional challenge because it requires the insurance intermediary to balance the client's immediate perceived need with the regulatory obligation to provide accurate and comprehensive advice, particularly concerning specialized insurance products. The intermediary must navigate the potential for misrepresentation or omission of crucial information that could lead to underinsurance or a complete lack of coverage for a significant risk. Careful judgment is required to ensure the client fully understands the scope and limitations of the proposed coverage. The correct approach involves proactively identifying the client's specific risk exposure to flood and recommending appropriate coverage, even if it means suggesting a policy that is more complex or costly than the client initially considered. This aligns with the regulatory framework's emphasis on acting in the client's best interests and providing advice that is suitable for their circumstances. Specifically, under the Insurance Distribution Directive (IDE) principles, which are foundational to the insurance mediation certificate, intermediaries have a duty to understand the client's needs and objectives and to provide clear, fair, and not misleading information about products. Recommending a standard policy without addressing the identified flood risk would be a failure to meet these obligations, potentially leading to a complaint and regulatory action. An incorrect approach would be to simply accept the client's stated preference for a standard policy without further inquiry or recommendation regarding flood coverage. This fails to meet the duty of care and the obligation to provide suitable advice. The regulatory framework expects intermediaries to be proactive in identifying and advising on risks relevant to the client's situation, especially when specialized risks like flood are evident. Another incorrect approach would be to downplay the significance of flood risk, or to suggest that standard policies offer adequate protection against such events without proper qualification. This constitutes misleading information and a failure to act in the client's best interests, violating principles of transparency and fairness. Finally, an approach that prioritizes securing the sale of the standard policy over ensuring adequate coverage for identified risks is ethically unsound and breaches regulatory requirements for professional conduct. The professional decision-making process should involve a thorough needs analysis, including a detailed assessment of the client's specific risks. When specialized risks are identified, the intermediary must research and present suitable insurance solutions, clearly explaining the coverage, exclusions, and costs. Transparency about the limitations of standard policies and the benefits of specialized coverage is paramount. If a client resists recommendations for specialized coverage, the intermediary should document the advice given and the client's decision, ensuring the client understands the potential consequences of not obtaining adequate protection.